is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Sintra, Portugal, and here's what's coming up on today's program. Inflation fears hang over this ECB forum as policymakers worry that tackling it could tip the continent into recession. We hear from Christine Lagarde imminently. Oil's on the rise again as Macron tells Biden the UAE and Saudi Arabia are pumping near their limits. Sources say the G7 could scrap some fossil fuel commitments. And as Credit Suisse is hit with a historic money laundering conviction, the bank also announces a turnaround strategy as it seeks to emerge from 2 years of scandals and losses. Now, first thing is up. Let's check in on the markets. Our Danny Berger is in London. Danny, what's it looking like?
Well, Francine, we first got this boost to risk assets from this news that China would be cutting their quarantine period in half for inbound travelers and those coming into close contact. So that initially lifted equities. But the thing it also did was it lifted risk assets in general. It sent bonds lower. It sent oil higher. So equities, at least here in Europe, just up 0.5%, not able to make that huge rebound that you might otherwise see with growth, because if more demand is coming back onto the map, that just sort of adds to the issues of supply-demand dynamics. It also means that things like tech struggle to make any headway. So we are seeing technology shares in the stock 600 that they are dropping by about 0.8%. Some of the best performers, those include oil and gas. A lot of the more cyclical type assets, those are doing better. Now, the U.S. dollar, that's also basically unchanged. Euro is a little bit stronger this morning as well. I should say bonds across the board in the European sovereign space, yields are moving higher there. Of course, Francine, that's off the back of your fantastic interview with the ECB's Kazakh saying that, look, it could be 50 basis points in July. It makes sense to front load it, he said. So that got us higher, especially on the 2-year yield, those higher by about 7 basis points. And finally, Bitcoin, always a great indicator for risk appetite and perhaps a sign that despite that China news, we're not seeing risk appetite come back too strongly. We're seeing Bitcoin little change, just under $21,000. And I'll give you a quick view of the entirety of Europe on the Europe map. Map Markets Go is where you want to head on your terminal. And again, it is green, but it's not as strong as it had been. Some of the more stronger regions, for example, because we had seen energy, those types of things do well. UK stocks, those are up more than 1%. At the same time, FTSE MIB, that's up 0.9% as well. CAC 40, that's up 1%. DAX up 0.6%. Of course, interesting to see the DAX, for example, not doing as well. One of those higher cyclical, those higher beta type indices not doing as well. Now, Credit Suisse, that will be an interesting one to watch as well. In the stocks today, in the market action, they're trading just slightly higher. That's, of course, Credit Suisse unveiling their investor day, not an official investor day, but a deep dive into what's happening there. They're really hoping to turn around their wealth management, focus on richer clients, especially when it comes to Asia, Singapore, Hong Kong, those types of regions. Now, about an hour ago in London, they started this investor deep dive. Of course, we know some of the details already from a presentation that they are set to give, some of the slides there. But will it be enough to soothe investor concerns? Considering just yesterday they were convicted by a top Swiss court of money laundering issues there when it comes to a Bulgarian cocaine trafficker. So, Francine, I know Credit Suisse, it's a story you know very well. This investor day, not unveiling, the most concrete targets, but still a lot for them to work through and to get investor confidence back.
Yeah, it is, just because it's been such a long time, Danny. It's, been Archegos, it's been a number of other things. And of course, profit warning after profit warning. You just wonder what it means for outflows, what it means for investor confidence, and of course, client confidence. So maybe this is the time that Thomas Gottstein can really get out front. Talking about out front, it's all about front loading ECB rate hikes. Now, I just had, Danny, a very interesting discussion with Eric Nielsen. He says, look, front loading, the idea that you do 50 basis points in July, because then it gives you more optionality towards the end of the year. He says this is the wrong way of looking at it, because it's extremely difficult to predict what's going on. So this could lead to policy errors. So the ECB, he believes, can only do what's in front of them here and now. But then you speak to, of course, some of the hawks, including the Latvian central bank governor, and he says, look, something that they need to look at is a 50 basis points in July.
Yeah, I think that this is a really interesting question, especially, you've spoken to Christine Lagarde about this really concrete forward guidance they've given. Doesn't make sense to do that in this era where there's a lot of uncertainty. All right, well, Francine, we are, of course, waiting for Madame Lagarde to speak. But in the meantime, let's get over to our top stories today with the Bloomberg First Word News is Leanne Gerrans. Hi, Leanne.
Hi, Danny. Bloomberg has learned that G7 leaders are set to instruct ministers to explore implementing a price cap on Russian gas. The mandate could be announced at the end of the G7 summit later today as part of efforts to limit Moscow's profits from exports. Leaders are also expected to mention a plan to cap prices of Russian oil, which could work by imposing restrictions on insurance and shipping. China has reduced quarantine times for inbound travellers. Now, that's by half, the biggest shift yet in its strict COVID-19 policy. Incomers will now only need to spend 7 days in a facility and then monitor their health at home. And that will be for a further 3 days. That's down from 14 days hotel quarantine in the past. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne Gerrans in London. Thank you so much. Well, let's quickly get over to Sintra, where Francine is. Go ahead, Francine.
I just saw Christine Lagarde walking about 5 minutes ago, and I think she's just speaking right behind me at the monastery. So let's go straight to the ECB President Christine Lagarde.
For the first time in 11 years. And we have provided some guidance for our September policy meeting and the rate path that we envisage thereafter. We will continue along this normalization path, and we will go as far as necessary to ensure that inflation stabilizes at our 2% target over the medium term. As Victor Hugo is said to have remarked, perseverance is the secret of all triumphs. So we shall persevere. At the same time, the euro area differs from some other major economies for two key reasons, and the path of normalization has to be managed accordingly. First, inflation in the euro area today is being driven by a complex mix of factors that reflect, in part, our economic structures and strategic dependencies. And this creates uncertainty about how quickly inflation will return to our medium-term target. In this setting, we need to act in a determined and sustained manner, incorporating our principles of gradualism and optionality. This means moving gradually if there is uncertainty about the outlook, but with the option to act decisively to any deterioration in medium-term inflation, especially if there are signs of a de-anchoring of inflation expectations. Second, the euro area has a unique institutional setup built around 19, actually soon to be 20, not yet fully integrated national financial markets, and 19, soon to be 20, national fiscal policies with limited coordination. I can see that some of our from abroad colleagues are frowning. The 20th is Croatia, which will be officially in the euro area club as of the 1st of January, but which has been approved as a full-fledged member of the euro area, hence soon to be 20. This special institutional setting presents the risk of our monetary policy stance being unevenly transmitted across the Union. And this is why we have emphasized all along that flexibility is integral to the process of normalizing our monetary policy. It is essential to allow us to deliver the necessary policy stance and protect price stability in an environment where inflation is too high. So what would I like to do today, if your attention span permits, is answer 3 questions and outline how a combination of shocks is currently hitting the euro area economy. Second, how our monetary policy stance should react to the challenges that these shocks create. And third, how can we preserve the transmission of this stance throughout the euro area? So, how are the shocks hitting the euro area economy? Broadly speaking, inflation in the euro area is being driven by 2 different types of shocks. First, the original source of inflation is an extraordinary series of external shocks. Global supply chain disruptions, coupled with surging global demand, have pushed up prices sharply for industrial goods along the pricing chain. Mismatches between supply and demand in global energy markets have led to rising energy prices for the euro area. And the unacceptable Russia-Ukraine war has amplified both of these factors while also driving up global food prices. Given its energy dependence, the euro area is experiencing these shocks acutely. The current level of food and industrial goods inflation have not been seen since the mid-80s. And the increase in the relative price of energy in recent months is much higher than the individual spikes that occurred in the 70s. Together, energy and food and industrial goods account for 82% rate seen since the start of this year. That was the first series of shock. That is the first key. In internal demand, in spending is rotating from goods back to services as restrictions are being lifted, while pent-up demand for tourism and leisure activities is proving unexpectedly strong. This rebound in spending has seen services inflation rise to 3.5% in May, the highest rate seen since the mid-90s, with the highest price increases, not surprisingly, in contact-intensive services. These shocks, in particular the surge in energy prices, are driving up short-term inflation to very high levels. They are also leading to significant upward revisions to our medium-term inflation forecast. The June Eurosystem staff projections saw inflation above 2% for the whole projection horizon, converging back to slightly above our medium-term target in 2024. But the size and complexity of these shocks are also creating uncertainty about how persistent this inflation is likely to be. We are not facing a straightforward situation of generalized excess demand or overheating economy, in which case a trajectory of medium-term inflation would have been clearer. Despite the bounce back in services that I've just referred to, private consumption in the euro area is still more than 2% below its pre-pandemic level, and investment remains subdued. Although there have been signs of above-target revisions in recent months, longer-term inflation expectations currently stand at around 2% across a range of measures. This supports our baseline projection for inflation to converge back towards our medium-term inflation target. At the same time, inflation pressures are intensifying and broadening through the domestic economy. Almost 4/5 of items in the consumption basket had annual price increases above 2% in April. And this is not only a reflection of high import prices. A new ECB indicator of domestic inflation, which removes items with a high import content, currently stands above 3%. So in this environment, it is important to understand how persistent domestic price pressures are likely to become. And there are several factors worth considering here. First, inflation is starting to take root in the services sector, which is the stickiest component of inflation and has a higher weight than goods. Second, unemployment in the euro area is at a record low. Labor shortages are broad-based across sectors, and indicators of labor demand remain strong. Not as much as in other large economies, but still. This tightening of the labor market, together with the catch-up effect triggered by the high inflation environment, suggests that wages should pick up and grow. Our latest forecasts see wage growth above 4% in 22 and in 23, and at 3.7% in 24, almost double the historical average before the pandemic. Third, these factors combined have led us to project core inflation at 2.3%, core inflation, at 2.3% in 24, and in the euro area, core inflation tends to be a good indicator of headline inflation over the medium term. We are also seeing signs that the supply shocks hitting the economy could linger for longer. While it is reasonable to assume that global supply chain disruptions will gradually be resolved, the outlook for energy and commodity prices remains clouded. Unfortunately, there is not yet an end in sight in the Russia-Ukraine war, and we face the risk of cuts to supply that could keep energy prices high. That could contribute to inflation directly if it leads to further rises in energy costs, or indirectly if a higher level of energy prices makes some production uneconomic and leads to a durable loss of economic capacity. The war is also likely to accelerate green transition in Europe as a way to enhance our energy security. In the long term, this should lead to lower energy costs in Europe. But in the meantime, it could lead to price increases for rare minerals and metals, higher costs for the investment needed in clean technologies, and an expansion of carbon pricing schemes. And we all know that a less than orderly transition will be more costly. Now, that said, these shocks also have implications for growth, and as such, they can weigh on the medium-term inflation outlook, and we need to understand what we see in that regard. The external supply shock hitting the euro area are affecting spending. Rising import prices represent a terms of trade tax, which reduces the total income of our economies. Households are seeing their real income being squeezed. Real wage growth has been negative for 2 consecutive quarters. And consumer surveys suggest that households are expecting their real income and consumption to decline further over the next year. Firms, for the moment, are trying to protect their margin by raising prices. But this uncertain environment is also leading them to delay investment decisions. And sales growth appears to be decelerating. The latest PMI points to no further growth in new business, and business expectations in a year's time have reached their lowest since October 2020. At the same time, spending is being supported by the boost to demand from the full reopening of the service sector in particular. And consumption is being buffered by, one, the large stock of household savings built up during the pandemic, two, fiscal support measures, and three, the continued strength of the labor market, which is helping to sustain labor income overall. But if supply shocks drag on and inflation continues to exceed wage growth by a wide margin, losses in the real income could intensify and the excess savings buffer could be eroded. The resulting hit to demand could test the resilience of the labor market and possibly temper the expected rise in labor income. So in this setting, we have revised markedly down our forecast for growth in the next 2 years. But we're still expecting positive growth rates due to the domestic buffers against the loss of growth momentum. This is our baseline. So what does that all mean for what we have coined our normalization process? Based on the overall outlook, the process of normalization, our monetary policy will continue in a determined and sustained manner. But given the uncertainty we still face, the pace of interest rate normalization cannot be defined ex ante. As I laid out in a recent blog post, the appropriate monetary policy stance has to incorporate the principles of both gradualism and optionality. Gradualism allows policymakers to assess the impact of their moves on the inflation outlook as they go, which can be a prudent strategy in times of uncertainty. Optionality ensures that policy can react nimbly to the incoming data on the economy and inflation expectations, and if uncertainty decreases, re-optimize the policy path as necessary. And indeed, there are obviously conditions in which gradualism would not be appropriate. If, for example, we were to see higher inflation threatening to de-anchor inflation expectations, or signs of a more permanent loss of economic potential that limits resources availability, we would need to withdraw accommodation more promptly to stamp out the risk of a self-fulfilling spiral. These two elements taken together, I know it's easier to say it's one or the other. Our analysis is that we need to actually blend those two together and be just more subtle and deep in the diagnosis that we have to pass and the conclusions that we draw. So these two elements taken together of our monetary policy stance underlie the Governing Council's decision of our meeting of June the 9th. Let me try to explain. Consistent with moving gradually, we announced that we will end net asset purchases under our asset purchase program on July 1st and intend to raise our 3 key interest rates by 25 basis points at our next meeting on July the 21st. We also announced that we expect to raise the key interest rates again in September, and, I quote, "If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting." Now, this reflects the optionality principle. If the inflation outlook does not improve, we will have sufficient information to move faster. This commitment is obviously data dependent. This optional approach to the pace of interest rate adjustment should not be confused with delaying normalization. As our policy stance rests on a clear reaction function, interest rate expectations and risk-free rates can adjust in advance. Actually, our policy adjustment is already working its way through the euro area economy. The euro STR forward rate 10 years out is around 240 basis points above its pre-pandemic level, without policy rates having yet moved. The one-year forward real rate 1 year ahead and the five-year forward real rate 5 years ahead are around 100 and 140 basis points higher, respectively. Beyond September, the Governing Council has agreed that a gradual but sustained path of further rate increases will be appropriate. The starting point at each meeting, every 6 weeks, will be an assessment of the evolution of the shocks, their implications for the outlook, and the degree of confidence we have in inflation converging to our medium-term target. So let me talk a little bit about what is consubstantial to our monetary policy stance, which is the transmission. For these changes in our monetary policy stance to be effective, we need to preserve the orderly transmission of our stance throughout the euro area. The euro area is not one country with one fiscal authority, with one capital market union, unfortunately, and one banking union in development. So the ECB is conducting monetary policy in this incomplete monetary union, in which its policy has to be transmitted through 19, soon to be 20, different financial and sovereign bond markets. The yields on those sovereign bonds provide the benchmark for pricing all other private sector assets in the 19, soon to be 20 member states, and ultimately also for ensuring that our monetary policy impulse reaches individual firms and households throughout the whole of the euro area. If spreads, for instance, in some countries respond rapidly and disorderly to an underlying change in risk-free rates over and above what would be justified by economic fundamentals, our capacity to deliver a single monetary policy is impaired. In this situation, a change in the policy stance can be followed by an asymmetric response of financing conditions, regardless of the credit risk of individual borrowers. In such conditions, when we have what we describe as unwarranted fragmentation, preserving policy transmission is a precondition for returning inflation to our target. This is part and parcel of our mandate. But in order to preserve the orderly transmission of our policy stance throughout the euro area, we need to ensure that this repricing is not exacerbated and distorted by destabilizing market dynamics, leading to a fragmentation of our original policy impulse. That risk of fragmentation is also affected by the pandemic, which has left lasting vulnerabilities in the euro area economy. These vulnerabilities are now contributing to the uneven transmission of the normalization of our policy across jurisdictions. So the Governing Council is acting in two ways. First, we will use flexibility in reinvesting redemption coming due under the Pandemic Emergency Purchase Programme to preserve the functioning of the monetary policy transmission mechanism. In other words, those redemptions can, as appropriate, be invested within the euro system in bond markets of jurisdictions where orderly transmission is at risk. We have decided to apply this flexibility in reinvesting redemptions coming due in the PEP portfolio as of the 1st of July. Second, we have mandated the relevant Eurosystem committees together with the ECB services, to accelerate the completion of the design of a new instrument for consideration by the Governing Council. This new instrument will have to be effective while being proportionate and containing sufficient safeguards to preserve the impetus of member states towards a sound fiscal policy. This decision lies squarely within the ECB's tradition. In the past, the ECB has made use of separate instruments to target inflation and to preserve the functioning of the monetary policy transmission mechanism. Measures to preserve transmission could be used at any level of interest rate, so long as they were designed not to interfere with the monetary policy stance. At times when inflation fell too low, it made sense to shift from separation to combination, so that all tools reinforce the required policy easing. That is why, for example, we linked asset purchases tightly to forward guidance on rates. But with high inflation now being the main challenge, there are merits in separating policy tools again. Preserving policy transmission throughout the euro area will allow rates to rise as far as necessary, and in this sense, there is no trade-off between launching this new tool and using it and adopting the necessary policy stance to stabilize inflation at our target. In fact, one enables the other. So let me conclude. The euro area is facing a complex mix of shocks which are reducing growth and pushing up inflation. In this environment, it is imperative for policymakers within their respective mandates to address the risks to the economic outlook. Fiscal policymakers have to play their part in reducing these risks by providing targeted and temporary support, while over the medium term, following a rules-based framework that underpins both debt sustainability and macroeconomic stabilization. We are unwavering in our commitment to ensure that inflation returns to 2% over the medium term. We have designed a strategy to normalize our policy that allows us to respond nimbly to the high inflation environment. And we will ensure that the orderly transmission of our policy stance throughout the euro area is preserved. As Leonardo da Vinci said, every obstacle yields to stern resolve. We will address every obstacle that may pose a threat to our price stability mandate. We will. Thank you very much.
Well, that was Christine Lagarde, the president of the European Central Bank here in Sintra, Portugal, kicking off the forum. This is usually a retreat. Let me tell you, the central bankers here will do everything but relax. Now, in that speech, extremely rich, talking about fragmentation, some of the tools, no specifics on actually the tools, but it was interesting that she decided, first of all, to restate 25 basis point hike in July, but still keeping the optionality. So the way she puts it is, look, we're going to go gradually unless there's really something that's worrisome when it comes to inflation. And then, Danny, I thought it was really interesting at the end when she was almost warning the markets not to test them. Now, we didn't really have that much nuance or details on what kind of tool to deal with fragmentation is. But by saying that policymakers are ready to step up action to tackle record inflation and that this new bond buying tool will facilitate rather than hinder getting price pressures under control, she's basically almost, firing a warning shot and saying, guys, they have this because they want to make sure that it reaches every side of the market, including a periphery. Now, we will continue, of course, our live coverage from Sintra, Portugal, over the next 2 days. We have Jim Bullard of the Fed here. We have Loretta Mester, Jay Powell, and Lanz a little bit later tonight in windy Sintra. And then I have this pretty extraordinary monetary policy panel tomorrow, 2 p.m. London time, The focus will be, of course, on inflation and the challenges in setting monetary policy. I'll be speaking to Christine Lagarde, Andrew Bailey of the Bank of England, Agustin Carstens of the BIS, and, of course, Jay Powell of the Fed.
Yeah, Francine, a really interesting speech there from Christine Lagarde, as you say, pushing this gradualism and optionality. Of course, coming off the back of your fantastic interview with the ECB's Kazakh, saying, look, 50 basis points, that's something we might want to consider in July. Of course, Christine Lagarde shot that down. Well, let's get a reaction from Sweta Ramachandran, investment manager at GAM. So, Sweta, how are you digesting what we just heard from Christine Lagarde? 25 basis points in July, perhaps more in September, versus other policymakers saying, hey, perhaps it makes sense to load up on the jumbo hikes now versus waiting around.
Yeah, it's certainly a more nuanced approach versus the UK and the US central banks, which are all about taking the medicine now. And I think the gradualism that they're advocating for at the ECB is a function of their particular specificities in the labor market in the ECB more than anything else, which is that the US is seeing, very hot demand that they need to cool down urgently, whereas the case is not necessarily the same in Europe, of course, energy price inflation, which is much more severe in Europe than it is in the US.
We even had Christine Lagarde talking about the fact that private consumption, they're below pre-pandemic levels, that business investments are subdued as well. I mean, can the ECB really go full steam ahead if this is the environment that they're contending with?
I think she also highlighted potential positives, which are that households are still sitting on extra savings, this huge buffer of savings that she referred to, and the fact that that could be eroded should inflationary pressures persist. But it seemed to be more of a possibility than an actual reality, where we are seeing, for instance, in the US, excess savings are being eroded, savings rates are coming down, whereas in Europe, the situation seems to be a little bit different, which is what surprised me on the positive.
Sweta, I mean, thank you. This does remind me that sometimes my journalistic skepticism just turns into straight up doom. So thanks for reminding me. She also had some optimism there as well. And she also, again, saying that we are data dependent. Sweta, how important then are these inflationary readings we're getting this week? We're getting some flash inflation numbers from Europe. We have CPIs later in the week. How much volatility in terms of market reaction could we see around them?
And I think that's exactly why she, reiterated this notion of optionality, which Francine also referred to, is that any policy outcome from here will have to be data dependent. And clearly, these measures are going to be quite important. There's already widespread expectation that inflation is could be peaking. If we're not there yet, perhaps in coming months we could be there, although the near-term prints look set likely to be quite high. And I think that that's why they want to allow themselves enough optionality to consider, on the one hand, any sort of labor market impact that they might see from moving too quickly versus moving too late and letting inflation get out of control.
And of course, the other thing that might be a huge factor, most certainly will be, we have the G7 meeting. Of course, Russia has shut off about 60% of its gas supply to the rest of Europe. We've heard some musings from the G7. The latest headline, G7, they're tasking ministers, this now official, to urgently discuss an oil price cap on Russia. Sweta, how crucial is it that Europe figure out energy security and figure it out now?
Absolutely. Right now it's the summer. Clearly, usage is seasonally quite low, but heading into the winter, the autumn season, it's absolutely imperative that this gets resolved to prevent, say, at the worst case, we're already hearing noise about rationing, to prevent that getting worse, and then to sort of create this spiral of an economic downturn brought about by energy prices that are way too high.
Sweta, thanks so much, giving us that instant reaction after hearing from Madame Lagarde. Sweta Ramachandran, their investment manager at GAM. Now, coming up, the ECB forum, it continues today. We've just heard from ECB President Lagarde. We're going to get reactions as well from Ricardo Reis, economic professor at the London School of Economics. This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance early edition. I'm Francine Lacqua here in Sintra, Portugal. Now, crypto, of course, gone through several major drops in history, but this time it might be a little bit different. The market's expansion and increasing adoption from Main Street to Wall Street means more is at stake now. Well, with us now is Nan Narula, Director of the Digital Currency Initiatives of the Massachusetts Institute of Technology Media Lab. Nan, thank you so much for joining us. A refreshing break from monetary policy is actually what a lot of these central banks need to do with digital currencies. If you look at China, they seem to be a bit ahead of certainly what Europe and the Bank of England are doing. Is there a first mover advantage in this?
I think that there is quite a chance there is a first mover advantage, Francine, because whoever goes forward the fastest and first has the ability to set standards. So technology standards and global standards are very important in this area for interoperability, for cross-border compatibility. And so China, I think, does really have a head start here. Now, that doesn't mean that it's insurmountable by any means. And, you know, I think it's going to be very interesting to see what happens in the next couple years.
Yeah, so how do you see it panning out?
Absolutely. So unfortunately, I think there's this false narrative that central bank digital currency competes with or is in contrast to cryptocurrency, when in fact, actually, the two really are quite aligned. It's all about upgrading money, and it's all about the future of money. We see so much exciting experimentation and innovation in the cryptocurrency world, and that is feeding back into the public money design and sector. So, you know, and the Western world has quite a bit of an advantage there. There's so much happening in the digital currency and cryptocurrency space.
But now, when you speak to a lot of central bankers, they're actually really quite concerned about cryptocurrency. So is it because they don't know how to regulate it, because they can't measure the impact it has on retail investors if something goes wrong?
You know, it is a new technology, Francine, and with any new technology, it creates new paradigms, and that's going to cause a bit of tension and a bit of stress as we figure out how to handle these new paradigms, how to regulate these new paradigms. We're moving forward. It's happening. It's happening slowly, but it is happening, and it does need to be done carefully to make sure that this technology can reach its promise.
Yeah, thanks so much for joining us. Nan Narula, the Director of the Digital Currency Initiative. Dan, I'm going to send it back to you in London.
Well, coming up on the program, Francine, we're going to get the latest from the G7 meeting in Germany. Leaders there looking at a possible cap for Russian gas prices, as well as one for oil. More from Bavaria, and of course, with Francine in Sintra next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, Francine Lacqua in Sintra. Now, the G7 meeting continues to be underway in Bavaria. We have France's Emmanuel Macron recently telling President Biden that the UAE's ruler confided to him. But before we get to that, you're looking at some live pictures there. A meeting there. We see Joe Biden. Boris Johnson appears to be fist bumping. There you go. Olaf Scholz sitting down. Still no ties, I would mention. We also have von der Leyen at the table. Looks like they've got plenty of coffee to keep them going. So, of course, the conversations have been ongoing throughout this meeting in Bavaria. We're also hearing that G7 leaders are looking for a cap when it comes to Russian gas prices. That's as well as one for oil. Well, not too far away from that is Bloomberg's Washington correspondent Anne-Marie Hordern, who, of course, at the moment is there in Bavaria. So, Anne-Marie, we finally have this communique. They're putting their ministers to work, get this price cap going. How difficult is it going to be to put it into practice?
Well, it's incredibly difficult, and we should note this communique is not even putting any mechanism into practice. There's no caps that are set. There's no dates that are set for when this would actually hit a market. But what it does do is it shows that there's agreement amongst these G7 leaders that talks can continue with a potential end game of having a price cap. So first you have on Russian gas. That's incredibly important for Europe. This is something that Italian Prime Minister Mario Draghi has really pushed for. The issue here is many say this could potentially distort the market. Also, Russia's going to have to want to play ball. And then second, when it comes to an oil price cap, again, there is absolutely no time set on this. There is no price set on this. But the idea is that they want to be able to keep that Russian crude on the market, but make sure they limit the profits that President Vladimir Putin can take in. Last month, Danny, $20 billion Russia brought in from their exports of fossil fuels. And for all of these countries, while they want to make sure they are still keeping that pressure up on Russia, they want to ease the inflationary pressures at home, especially for President Joe Biden when you have gasoline hovering around $5 a gallon. We should note these talks are wrapping up. President Biden set to meet with Boris Johnson, Scholz, and as well as Emmanuel Macron this morning. Draghi was joined in on that, so the quad became a quint. Then President Biden is actually leaving a little bit earlier than scheduled to go over to Madrid for those NATO meetings because, as you can see here, it's getting a little bit stormy.
The good weather, perhaps, finally running its course. Anne-Marie, thanks so much. Anne-Marie Horder there at the G7 in Bavaria. Francine?
Yeah, Danny, we're here back in Sintra, where the weather is also turning. I have to say, not for the best. A bit of sun, but very windy. This is probably some of the headwinds that central banks will have to face in the coming months and years. Because if you look at the acceptability of central banks to do something with interest rates, it's not something that the market is taking lightly. We've heard from Christine Lagarde this hour, trying to dig a lot deeper into the European economy. With me now is Ricardo Reis, Arthur Williams Phillips Professor of Economics at the LSE. Professor, thank you for joining me. A lot to talk about. First of all, the commitment from Christine Lagarde, 25 basis points hike in July, and then let's see. So she keeps that optionality, although she seems to prefer gradualism. Why not go big and hike 50 basis points in July to be done with inflation, or at least try and keep a handle on it?
Well, if you look at the current data, there's certainly very worrying concerns about both how high inflation is and especially how expectations of inflation from household surveys as well as market prices to be hiking up. That would justify, indeed, a strong response. However, there's still quite a lot of uncertainty, and the ECB prizes its gradualist policy. Given that, doing a smaller increase now, but keeping all options open for potentially much higher increases down the line, seems to be an adequate response to that uncertainty in the data.
So
notably today, note that President Lagarde...
Professor, you wouldn't front load now. Does that not give you more tools as then we go into the winter months? There's demand problem for energy and also prices will go up?
I think it would certainly be an option. Personally, probably I would have favored more of a front loading, but I understand the choice has been done, and one in which, crucially, as President Lagarde noted today, all cards are on the table. The commitment to price stability is paramount, and the ECB will do whatever it takes to keep inflation under control.
Yeah, if this takes too long, is the ECB actually hiking in a recession?
It could happen. Indeed, if inflation stays high, hiking becomes necessary, even if the economy is entering a recession. And the more one delays, the more that risk arises. And so that's certainly a risk and a gamble that the ECB is taking right now.
Professor, talk to me a little bit about fragmentation. So she says, we will not tolerate some of the transmission mechanism to not reach every part in the marketplace. This basically means that they're working on some kind of tool. Will the market test it until we know what that tool is?
I think for sure markets will test commitments that are still not clear. That I think is the nature of how these things usually happen. But importantly is how also in the speech, President Lagarde started doing something that's very important and which central banks have not done until recently. And that is to separate asset purchases from interest rates. It is crucial to raise interest rates, perhaps even faster, more front-loaded, as we were just saying, in order to control inflation. That does not need to mean that one needs to also at the same time be unwinding asset purchases very quickly. One could indeed have asset purchases while raising interest rates in order to both address the increase in inflation as well as any fragmentation fears. And that door is now open. And thankfully so, it should have been open 6 months ago.
But what's crazy is that we're now in June, 2022, and actually the ECB has not done much. But actually, if you look at tightening conditions, they've certainly, increased a lot more. And the market has done a lot of the work that the central bank had to do. Is the market now leading all the central banks around the world?
I wouldn't say so. If you look at the markets, they are responding to the announcement of the central bank. In some ways, it is showing the power for guidance of communication that simply a change in stance and communication by the central bank leads immediately to a tightening. That is a promise of what will be done in the next 6-12 months, immediately has an impact right away. Having said that, those announcements, to stay credible, need to come with actions. And those actions are coming and maybe could be coming faster.
Forward guidance is not working in this kind of environment.
Well, is it not working? But after all, as you just said, credit conditions have tightened significantly on announcements of future increases in interest rates. That is forward guidance working.
Yeah, it feels like the central banks are always a step behind the markets. That's definitely leading it. Thank you so much for joining us, Ricardo Reis, Arthur Williams, Phillips Professor of Economics at the LSE. Now, we'll have plenty more, of course, from Sintra, Portugal. In the meantime, I know there's also a bit of movement on the markets, Danny.
Yeah, there certainly are. We are looking at European yields. They continue to move higher, Francine, perhaps not as high as they had been after we heard from Kazakh speaking to you saying 50 basis points might be appropriate for July. Instead, what we got was Christine Lagarde saying it's 25 basis points in July, but perhaps in September they'll move more if necessary. We've seen the markets, those start to price in 50 basis points for September. Likewise, your 10-year German yield, that up 6 basis points. Similar moves when it comes to the UK as well. Those are up about 6 basis points. Italian 10-year yields, notable, those aren't blowing out as well. We had a report from Reuters talking about their aims to keep spreads in check, but at the same time making sure it's not QE. Some of that has to do with removing liquidity from the system, from the banking system, in order to make sure that tightening aim continues there. Now, at the same time, yields moving higher in Europe. They're pretty much steady in the U.S. That also leading to a stronger euro. Francine, the focus squarely in Sintra, where you are. I know you have a great lineup ahead of you, but really it's all about ECB policy today.
Yeah, it'll be all about ECB policy, but then we hear, of course, from Loretta Mester and James Bullard of the Fed. This is not an easy task. If you look at forward guidance, Danny, if you look at what the markets are pricing in, it's very clear that everything has changed. Inflation, obviously, the big problem, but markets seem to be more and more worried that actually this is not about central banks. It's not the central banks that will fix it, because if you look at the underlying condition of inflation, this is a supply shock. So how much can they actually do about output? So this is probably the most hard question that we'll try and answer. Bloomberg Surveillance, of course, continues in the next hour. Matt Miller, Kailey Leinz, and Anna Edwards. This is Bloomberg.
Inflation has proven to be much more persistent and much more elevated than we all thought.
We are at the beginning of the effort of turning inflation around. So far, so good, but we still need some ways to go forward.
The path of least resistance from here is still tighter financial conditions.
Central bankers all around the world have to give us a big mea culpa at some point.
China is in a very different place to the rest of the world.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, June 28th. Our top stories today. It's China's biggest shift yet in its tough COVID-0 policy. Beijing has cut the quarantine times for inbound travelers to 14 days to 7. ECB President Christine Lagarde vows to be nimble. A quarter-point rate hike is set for next month, but policymakers could go higher if needed to fight record inflation. Revamp at Credit Suisse. It vows to put years of scandal and losses behind it by attracting more rich clients and improving its technology. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Anna Edwards with Matt Miller and Kailey Leinz in New York. And Kailey, all eyes turn to Sintra. It turns to central bank policy. But for now, risk getting a bit of a boost from that China news.
Yeah, that really was the big news in Asia overnight, Danny. The idea that the quarantine times will be shortened, a step away from China's strict COVID-0 policy. So now an inbound traveler only has to quarantine for 7 days. That's down from 14. And that gave a really nice risk sentiment lift overnight, including for the CSI 300, which rose about a percentage point. But it is now up 19% from its low hit in April. So we are very close to being back in a bull market. Now, of course, it was more beneficial for some stocks, including those in the travel space. So you saw Trip.com up 16.5% overnight. That was the best performer in the Hang Seng Tech indexes. One of the laggards, though, in that index, once again, was Tencent. That stock down about 3.25%. Of course, investors continuing to digest the news that Prosus sold some of its stake. It plans to continue to do so in order to fund its own share buyback. So the largest shareholder of the company selling is weighing on sentiment for that stock. Finally, I wanted to note the Japanese yen weaker against the dollar. We remain in and around that 135 level, so right around the weakest level for the yen in 24 years. And we have a great story, our big take story today, out with the big short on Japan being back, the idea that traders are betting against JGBs, the idea that because of the weekend, the BOJ is going to have to abandon yield curve control. So make sure to check that one out. And I big take go on the terminal. Of course, you can also find that online. I believe the address is bloomberg.com/big-take, Matt.
I love the Widowmaker trade. I love the Widowmaker car. I like all kinds of Widowmakers. S&P futures right now up about 0.5% here, and investors are selling 10-year debt, getting out of the perceived safety of government debt in order maybe to invest in risk assets like stocks. They're also buying crude oil. You can see NYMEX crude, Texas Intermediate right now up to 111.15, and Bitcoin is also rising. No surprise when you have futures up. Bitcoin gains about 1% from midnight to 21,139. What do European markets look like right now, Danny?
Matt, they also got a boost after China announced the plan to cut quarantine time in half. Again, for a lot of Chinese exposed companies, this is just frankly good news for growth. So about 1% gains for a lot of these indices. FTSE 100, that's up 1%. FTSE MIB up 1.3%. Reuters having a story about the ECB's desire to continue to keep spreads when it comes to Italy in check, but at the same time make sure that it doesn't lead to more quantitative easing. So commitment to Italy, to Italian debt, that perhaps helping out the region. One of the best performing sectors, though, I should say, in the Europe Stock 600, it is basic resources. That's up 2.6%. Again, it lends itself to this growth trade we're seeing right now if China demand starts to pick up in some serious way. That's also, Matt, you're showing oil there, so that also leading to why basic resources are doing well. Now, bonds have been an interesting one to watch today. The ECB's Kazakhs was speaking with Francine Lacqua just moments ago, basically saying that July, we should consider 50 basis points. You saw an immediate move higher in your German two-year yield. It was up by about 8 basis points at one point, but for our TV viewers, you'll see it's not that at the moment. It's basically just 5 basis points. That's because we just heard from Christine Lagarde saying she's sticking to the 25 basis point guidance in July. Perhaps September she'll go quicker if it warrants it. But that idea that, yes, they are committed to fighting inflation, they'll go faster if need be in September, that's keeping a bit into the euro. That up by 0.1% versus the dollar, Kailey.
All right, Danny. Well, of course, we will continue to monitor all of the remarks out of Sintra, but that is not all that is ahead on this Tuesday. We also will be monitoring geopolitics with President Biden wrapping up his G7 meeting with other leaders in the Bavarian Alps and now heading to Madrid for a summit with NATO members. Then on the topic of Sintra, the ECB's annual forum on central banking in Portugal is still underway. Plus, we'll be hearing from other Federal Reserve policymakers as well. San Francisco Fed President Mary Daly will be speaking at a LinkedIn interview at 12:30 p.m. New York time. And finally, we have primary elections in the U.S. today in the states of Colorado, Illinois, New York, Utah, Mississippi, South Carolina, Oklahoma, and Nebraska, Matt.
All right, that will be interesting for sure, considering the events of last week. Let's go now to what's going on in China. Hong Kong police have confirmed China's President Xi Jinping will visit the financial hub for the 25th anniversary of the city's handover. Meanwhile, China has reduced quarantine times for inbound travelers by half, the biggest shift in its strict COVID-19 policy. Enda Curran, Bloomberg Chief Asia Economics Correspondent, joins us now for more. So we finally have this trip confirmed, Enda.
Yeah, the trip is confirmed. All ears now will be on what message President Xi does have to send about Hong Kong, what role he sees Hong Kong playing for China in terms of its economic development and, of course, its role as a global financial centre, and whether, of course, he will give any commentary on how Hong Kong plans to reopen to the rest of the world. And like you mentioned, we did have that news on China's borders earlier on today. Some relaxation of the quarantine rules there, cutting it by half. Officials said that's because the virus is under control there. However, at the same time, they did say they're not deviating away from COVID-0. It's just that more scientific evidence more recently is allowing them to take this new approach.
Enda, thank you very much. Bloomberg's Enda Curran there in Hong Kong. Now to Portugal, where President Christine Lagarde and colleagues are meeting in Sintra to tackle the inflation conundrum. This morning, Lagarde affirmed plans for an initial quarter-point rate hike in July. But before those comments, Governing Council member Martins Kazak told Bloomberg's Francine Lacqua that a larger move next month could be reasonable.
The current focus is 25, but I think when we make the decision, it warrants yet another look at it. And if we see that the situation has worsened, that inflation reading is higher, and we see some kind of negative news in terms of, for instance, inflation expectations, then in my view, front-loading the increase would be a reasonable choice.
Well, let's get to the woman behind that interview. Francine Lacqua joins us now from a windy Portugal. Francine, fantastic interview. And of course, that contrasts with President Lagarde. In her words, how much optionality is she trying to leave herself?
Well, she does still talk about gradualism. Good morning, Danny, which is basically the idea that Christine Lagarde says, look, 25 basis points in July, and then from September onwards, we see with their data-driven. And of course, if inflation gets much, much worse from here, maybe they could go bigger. A lot of the people here in Sintra, there's about 50 economists, 29 central bankers, are toying with the idea that if you front load, it gives you much more optionality at the end of the year. Remember, at the end of the year is when we use more gas. It's when prices could go up, especially if there's a gas embargo from Russia. But again, this is not the only problem for central banks. If you look at the ECB, they need to deal with fragmentation, and Christine Lagarde was very clear that her transmission mechanism will be pushed in all sides of the economy, basically suggesting to the markets and telling the markets, back off, we have the tools to deal with fragmentation. We also have Loretta Mester of the Fed. We also have James Bullard, and then Jay Powell will be joining us this evening. The Fed, another set of problems. This is inflation that started. The cycle is also very different from when the ECB. But I think the fundamental question, be it the Bank of England, the Fed, or the ECB, is actually they had for 10 years, a decade, low inflation, relatively stable monetary policy, and now exiting, and the danger of hiking when the recession is looming. So hiking in a downward cycle is extremely tricky, and so we'll see whether they're able to engineer a soft landing and whether they're able to give us the clues here in Sintra.
All right. Well, a beautiful Sintra it is, but I hope you can get inside and out of the wind, Francine. Thank you so much. Bloomberg's Francine Lacqua reporting from Sintra. Now to NATO, which is set to label China a systemic challenge when it outlines its new policy guidelines this week. Bloomberg's also learned that the U.S.-led alliance will highlight Beijing's deepening partnership with Russia. Jens Stoltenberg, NATO Secretary General, spoke yesterday.
Our new concept will guide us in an era of strategic competition. I expect it will make clear that allies consider Russia as the most significant and direct threat to our security. It will address China for the first time and the challenges that Beijing poses to our security, interests and values.
Meanwhile, at the G7 meeting, which is wrapping up today, leaders are looking at a cap for Russian gas prices as well as one for oil. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from Bavaria, Germany, where that G7 summit has been underway. So, Anne-Marie, how did the conversations and commitments that have happened at the G7 inform the conversations about to happen at the NATO meeting?
Well, here at the G7, it was really about making sure they continue that pressure campaign against Russia, but at the same time, protecting their own economies. And that's really at the heart of the issue for the discussion of these caps, which we should say there's no deal on a cap, no set price on a cap, no set timeline for a cap on either Russian gas or Russian oil. But leaders have agreed that those conversations need to continue, and this is something that they would like to explore. When you look at the NATO meeting, and President Biden will be heading there shortly, he's actually wrapping up early here because, Kailey, it's getting quite stormy. He's heading over to Madrid. They're going to focus on China. And what is so interesting about this strategic concept document, the last one that came out was in 2010. China was not mentioned, and Russia, which is now the country that they are discussing today on how to keep pressure on, was labeled a partner. So it's going to be quite a contrast to the last time this document came out. And this is going to set the priorities for the NATO membership countries for the next decade.
All right, Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder in there reporting from Bavaria in Germany. Turning now to Credit Suisse as it seeks to emerge from 2 years of scandal and losses. Today, the bank is giving investors a deep dive into its strategy. Well, it's not really that deep. Sonali Basak, our global financial correspondent, joins us now. It's kind of a shallow dive, right? It's just like into a 6-foot deep pool.
Yeah, there weren't any overarching targets announced here today, but what was said was a long presentation that streamlined all that happened in risk management and compliance, and then honed in on wealth management, which is really the crown jewel of Credit Suisse, as you know, Matt. So also technology was a big focus because, as you know, many global banks here are focusing on technology to streamline costs, another thing that could help boost profitability at the end of the day. But also part of that risk management streamlining also means reducing risk in areas like emerging markets, non-investment grade debt. So tweaks, as you say, at the margin, but nothing overarching in terms of profit targets.
Well, we know that Credit Suisse has been under a certain amount of stress for some time, as we know. And of course, last week we also got the stress test results for the big U.S. banks. And as a result, some buyback and dividend payment announcements after the bell yesterday. What were your key takeaways?
Some nice and large, some more muted. So if you look at Goldman Sachs, Morgan Stanley, Wells Fargo really led the way in terms of dividend increases. Morgan Stanley also announced a buyback, which was a welcome reprieve for shareholders when stocks have fallen so much. Remember, Goldman and Wells Fargo are also trading just at or right under book value as well. But you have JP Morgan on the other side maintaining their dividend where it is in light of future higher capital requirements. Citigroup also held their steady. Mixed bag. I also want to point out really quickly, Jefferies, for example, had reported earnings, and they had shown that trading, investment banking is really moderating. That's really a bellwether. Shows that the fortunes of Wall Street this year are really coming down relative to last year, so caution is baked into these numbers, guys.
Well, there also looks to be some M&A action in financial services, Shonali, maybe financial services for the cool kids. I don't know. But you have FTX set to seek a path for a Robinhood deal, some Bloomberg reporting there. How likely does it seem?
Yeah, it's an interesting thing because FTX has already been doing a lot of deal making.
On a roll.
On a roll, totally on a roll. And also, as you say, Matt, kind of the white knight of the industry here, really throwing lines to a lot of companies that it could have strategic futures with. Think BlockFi or Embed. It bought a company called Embed just about a week or so ago, also focusing on stock trading. But Robinhood, remember, is a much bigger deal with a much bigger head count. FTX runs fairly lean itself. Robinhood right now is valued at about, trading at about an $8 billion market value. While that has come down so significantly from last year, Danny, last year it was trading at about a $60 billion market value. You do still have the issue that Robinhood would be a large deal for FTX. It would be almost a fourth of what FTX is worth today. So can they build it themselves, or would they need to buy it to gain the scale they need?
Well, this is something we'll continue to follow closely. Also, I would note Robinhood's headcount has been going down recently, so we have to keep that in mind.
As has BlockFi, as have all of the people that Sam Bankman-Fried have been reaching
versus slow and steady growth. So the cultural difference there is significant.
Yep. Well, this is probably a conversation we're going to have on Bloomberg Crypto later today, 1 p.m. Eastern time. So don't forget to tune in. Bloomberg Shonali Bostic, thank you so much. Now we want to move to one stock moving in free market trading that we're paying attention to, and that would be Nike. The world's largest sportswear company reported earnings after the bell yesterday, and the stock is down this morning. Bloomberg's Laura Wright has more on the results. Laura?
Thanks, Kailey. I told myself that watching Wimbledon for 3 hours yesterday was useful preparation for this hit. Overall, a slight beat on revenue, but rolling lockdowns in China, the catalyst for disappointing sales in the region. Greater China sales down 20% year over year. It's significant because Greater China accounts for around a fifth of Nike's total sales. It's why we're seeing Nike down almost 2.4% in pre-market trading. The disruption has led to a buildup of inventory, up 23% year over year. Remember that inventory for the retail sector was already at elevated levels because of supply chain congestion. That has put further pressure on gross margins, which landed below the street's forecast at 45% and are expected to remain flat in upcoming quarters. On the earnings call, Nike CEO John Donahoe stated that the company remains bullish on China in the long term. And if we take a look also at the next board I want to show you, it's North American sales. That was also notable, down 5% year over year. Perhaps this is a sign that recession fears and inflation are starting to bite. Is Nike a bellwether for other U.S. corporates ahead of this earnings season? EMEA sales robust for the time being, up 9% for the same period. A standout from Asia Pacific and Latin America, up 15%. Strong performances from countries including Mexico and South Korea. But looking forward, Nike will prioritize direct to consumer and online sales, cutting back on wholesale customers because Nike wants to take back control of pricing and its brand image.
Laura, thank you very much. Bloomberg's Laura right there with all the latest on Nike. Now, coming up on the program, we'll be speaking to Philipp Hildebrand, BlackRock Vice Chairman, when it comes to the inflation picture and central banks as well. Then we'll move on to the G7 and NATO. We'll be speaking with Elizabeth Ross, Senior Fellow at the American Enterprise Institute. Plus, the big Japan short is back for hedge funds betting against the BOJ. Read more of today's big take on Bloomberg.com or by typing NI Big Take into your terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kailey Leinz here in New York. Danny Berger is with us out of London right now. The Widowmaker. It's always any important ski area has a Widowmaker Black Diamond. The 1975 Porsche 930 Turbo was known as the Widowmaker, and shorting JGBs. This trade where you borrow yen and short the paper in order to hedge has ruined some of the most famous investors or hurt them seriously. A lot of them, like David Einhorn, have come back pretty well. We're looking at a huge short in JGBs right now, and our Simon White has been covering this very closely. Bloomberg MLive macro strategist. Simon, it does look like the Bank of Japan is going to find it really difficult to hold to its yield cap with everybody working against them.
Yeah, I think that's right, Matt. I've used, it sounds sensationalist, but to talk about crossing the Rubicon, this is uncharted territory. I mean, no central bank has owned half of its government debt in the post-Bretton Woods fiat paper money system. So we're really getting to a stage now where, as I say, this is new ground. This is new ground. I mean, you look at the Bank of England, the Fed, the ECB, they're nowhere even close. And the Bank of Japan, this week or last week, depending how you slice it and dice it, now owns 50%. And whether there's a sort of ineluctable logic now that once they own more than half, they begin to have to accumulate more and more. And before you know it, they are the lion's share. So I think it creates a huge imbalance.
Yeah, I think, what was it, yesterday, one of the lowest volume days in JGBs of the year. Certainly shows how just this is a market dominated by the BOJ. Simon, thank you so much. Great to get your thoughts as always. That's Simon White of Bloomberg MLive. And to get more great analysis from Simon and the rest of the team at Markets Live, MLive Go is where you want to head onto your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is off today. Now, keeping you up to date with news from around the world, here's the first word. A Russian missile attack on a shopping mall in central Ukraine has killed at least 18. Authorities say dozens more were wounded and more than 30 are still missing. A group of 7 leaders meeting in Germany called the attack a war crime. The People's Bank of China has pledged to keep monetary policy supportive to aid the economy's recovery. At the same time, the central bank signaled that stimulus would likely focus on boosting credit rather than lowering interest rates. PBOC Governor Yi Gang said that China's real interest rate is pretty low, taking inflation into account. And coming up, we'll continue the conversation on inflation, on the central bank response to it, and whether or not a soft landing is really possible. Philipp Hildebrand, BlackRock Vice Chairman, will be joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. It's China's biggest shift yet in its tough COVID-0 policy. Beijing has cut the quarantine times for inbound travelers from 14 days to 7. ECB President Christine Lagarde vows to be nimble. A quarter-point rate hike is set for next month, but policymakers could go higher if needed to fight record inflation. And revamp at Credit Suisse. It vows to put years of scandal and losses behind it by attracting more rich clients and improving its technology. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. And Matt, with oil moving higher, yields slightly moving higher, I'm surprised equities are able to hold on to some semblance of gains this morning.
Yeah, you know, I was just thinking about that as well because Laura was telling us about Nike, and there's going to be a little bit of margin compression there. That's a big company, $174 billion. And if that's what we start to see going forward, you're not going to see equity indexes continue to gain. S&P futures right now are up 0.6% as investors sell 10-year debt. The yield on the 10-year Treasury right now is 321.68, as you can see there. But crude is rising 1.33%. So if commodities, this is another problem for margins, right? If commodities get back to their upswing after the drop that we saw, that's going to be difficult for companies' earnings going forward. Bitcoin, of course, is very highly correlated to risk assets, and it is up 1%, it's 21,118. But it's important to note, it's really important to note that Kailey and I are going to be anchoring Bloomberg Crypto today at 1 p.m. So if you care at all about the crypto universe, definitely tune in. Kailey?
Yes, important to note. Most definitely, Matt. Now, as for some stocks moving in pre-market trading, I'm actually not keeping an eye on the crypto-related stocks, at least on my board today, but I am always keeping an eye on those. As for what I'm actually paying attention to, a lot of them are casino stocks after the news we got out of China overnight that they are shortening the quarantine period for inbound travelers. That could mean more people heading to Macau to gamble. And as a result, U.S.-based casino operators that have big operations, big revenue sources from Macau are higher in early hours. The likes of Las Vegas Sands up 7.3%. Wynn Resorts is higher by about 6 percentage points. There are some stocks moving to the downside as well. And one of them I wanted to point out is Robinhood. Of course, we had news before the end of trading yesterday, a Bloomberg scoop that FTX, Sam Bankman-Fried, the big crypto exchange billionaire, is looking at potentially a deal for Robinhood. The stock was up 14% yesterday as a result of that. Then after the bell, he told Dow Jones that there is no active M&A talks happening at the moment. So that is sending the stock lower in pre-market trading by about 3.7%. And one other stock moving lower, which Matt already mentioned, Nike, which reported after the bell yesterday, a little bit of margin pressure coming online. China also is an issue as well because its sales were already down 20% in the quarter they reported due to COVID-related lockdowns. They're still cautious on the outlook there, given some of that uncertainty. Nike is down 2.7% before the bell, Danny.
Well, China might be the reason or one of the reasons that Nike is falling today, but China is also one of the reasons that we are seeing stronger equities today. China announcing they plan to cut quarantine periods in half from 14 days to 7 days, and that really giving a boost to equities here in Europe. They started out the session basically directionless, now up 0.8%. But that also in turn has boosted a lot of commodities. Oil is higher, as you were pointing out, Matt. So was copper, so is iron ore. So stands to reason, basic resources, one of the best performing sectors in the Stock 600 so far this morning. But it's not just that. We also have to digest the macro of central bank policy. We had ECB's Cossacks talking about a 50 basis point hike in July. That seemed to be shot down a bit by Christine Lagarde in her speech, talking about it's 25 in July. Perhaps in September we move quicker. Then still we are looking at an uptick in yields in Germany. 2-year yields front end of the curve leading the way higher in yields. That's up by 6 basis points. Euro losing some of its steam, basically flat against the dollar after higher this morning, again with expectations of rate rises. But Kailey, continues to be this back and forth just because it's not just central bank policy the euro has been trading along, it's also just risk. If there is risk appetite, perhaps you move into the dollar or you move out of it depending on haven status. So that really making the euro more volatile than usual.
Yep, and it might stay that way for the next couple of weeks until we get that ECB decision. So on that note, let's head back to Portugal, where President Christine Lagarde and colleagues are meeting in Sintra to tackle the inflation problem. This morning, Lagarde affirmed plans for an initial quarter-point rate hike in July, as Danny was talking about. But before those comments, Governing Council member Martin Kazacs told Bloomberg's Francine Lacqua that a larger move next month could be reasonable.
My base case scenario is 25 in July, 50 basis points in September. But of course, given that our modus operandi is flexibility, optionality, day dependency, I think every and each time when we take the decision, it's just natural, again, to cross-check with the current situation at the time, what's the right move.
So, Governor, we're expecting actually some Eurozone inflation this week that could be at another record high. What would warrant a 50 basis point hike in July?
I think non-linearities in this respect are extremely important to take care of and follow as well. And what do I mean by that? It is what happens with the labor market. What happens with the anchoring of expectations? Do the expectations start crawling up? Do we see that price setting becomes more regular, more often? And in this case, I think kind of nipping the bud, as the president has said, to deal with such non-linearities is critical. And in my view, front-loading in this case would be a reasonable choice.
So 50 basis point high. I mean, if you look at what the Fed...
I would not front-jump it yet. Okay. The current focus is 25. But I think when we make the decision, it warrants yet another look at it. And if we see that the situation has worsened, that inflation reading is higher, and we see some kind of negative news in terms of, for instance, inflation expectations, then in my view, front-loading the increase would be a reasonable choice.
And because it gives you more optionality longer term. So is it something that the ECB could learn actually from the Fed?
Of course, we watch what other central banks are doing. Yeah.
And so that again, that means, so give us, and we talk about this front loading, the fact that it gives you just more tools to see what happens towards the end of the year.
I think the important thing is to address the expectations. Of course, monetary policy is in no position to address the core problems of the current hike in inflation, which is very much to deal with the war in Ukraine. But what we should care about is that when those negative supply-side shocks start to fade, then the inflation has not rooted in, and there are no second-round effects that would make inflation more permanent. And that's, in my view, the major task at the current moment. Nip the bud while it is still small.
ECB Governing Council member there, Martins Kazak, speaking with our Francine Lacqua. Now, coming up, we continue the macro conversation. We'll be speaking with Philipp Hildebrand, BlackRock Vice Chairman. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Ellen Zentner, Morgan Stanley chief U.S. economist. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Danny Berger in London. Anna Edwards is off. I want to get to what's going on in the Ukrainian war. A Russian missile attack on a shopping mall in central Ukraine, in Kremenchuk, has killed at least 18 people. Authorities say dozens more were injured and more than 30 are still missing. Now, we've just seen the G7 meetings in Germany, and leaders there called the attack a war crime. It's just one of the many instances of indiscriminate violence against civilians that we've seen in the 4 months of this war. Joining us now to talk about it, Elizabeth Braw, Senior Fellow at American Enterprise Institute. Elizabeth, to think that the Russians would target a shopping mall, or as we've previously seen, a hospital, a school, this deep into the conflict, why is that?
Yes, thank you for having me, Matt. It's almost as if Russia wants to deliberately shock the world and provoke the West, or specifically NATO, into some sort of response. All the while knowing that since this is not an attack on a NATO country, there isn't really very much NATO can do. We'll all be upset about it, and NATO leaders will be criticized for not doing enough. But Russia is clearly deliberately wanting to provoke outrage and also a sense of helplessness in the West. And we should remember that this shopping mall isn't close to any military installation, so you can't even claim it was a mistake. It was for all intents and purposes, a deliberate strike on a civilian target.
Right, and President Zelensky calling it an act of terrorism. What can be done here, or how close are we to an end to this Russian war?
Yeah, President Zelensky has said he wants the war to end by the end of this year. The only way it can end is by Ukraine getting more weapons, more ammunition to keep fighting against the Russians, because it's running low on ammunition, and it also needs more stronger weapons, more of the stronger kinds of weapons, for example, including the sort of weapons that it's expecting from Germany. So a Western makes of weapons. In the early stages of the war, it needed Soviet-style weapons. Well, it has now, unfortunately, had enough time for its soldiers to be trained on Western weapons, because the war hasn't ended as quickly as we had hoped. So there is pressure now on the world to supply the Ukrainians with more weapons and more ammunition, and they will keep fighting. This is the remarkable thing about this war. The Ukrainians are committed to fighting, and they are doing a lot of it, and they're taking heavy casualties, but they remain committed to defending their country.
Elizabeth, as Matt alluded to, this attack on the mall is just one of many atrocities we've seen over the course of the war. I don't think any of us will ever be able to forget the images out of Mariupol or Bucha. And yet, at the same time, do you get the sense that there is a bit of a people are becoming desensitized to some of these images, that there may be, Ukraine fatigue, and as that fire maybe fades, that the Western resolve to go against Russia is going to deteriorate?
That's definitely the case, Kailey. And if you look at newspaper coverage, which is an easy way of monitoring Ukraine fatigue, the war has moved, on most days, has moved from the front page to later pages in the newspaper, which suggests that people are really not that interested anymore. It's extremely unfortunate, because as is the case in liberal democracies, politicians take their cues from the public, and now the public in the UK, the US, Germany, Italy, France, and other countries is concerned about rising costs of living, rising costs of energy in particular, but also of food, and that's clearly a very tangible issue for most people, whereas the war is not a tangible issue. And yes, people in the rest of the world clearly feel sorry for the Ukrainians, but when your own costs, your own expenses increase, you will be more concerned about that. And that's what Western politicians have to act on, which is what I think risks pushing this war into the background. And yet, the longer it lasts, the bigger its effect will be on the globalized economy. So
well,
Western politicians are...
What is that in terms of the population, their opinions? What does that mean for the unity of Europe, for the U.S., and their approach to this war?
Yes, Danny, that's an excellent point. So I think that it's a very different situation in the U.S. compared to Europe, considering that the U.S. is shielded to some extent from the effects of this war, whereas European countries are more exposed. But that's exactly what G7 leaders are trying to reach agreement on at their summit in Bavaria, to make sure that we have Western unity, because the worst thing that could happen at this point is Western leaders, Western countries bickering among themselves about what needs to be done, with some countries suggesting that, it's now we have to look after our own house first, and others suggesting that now we should really stick with supporting Ukraine. I think so far at the G7 summit, they have managed to demonstrate unity, which is an important step in itself.
Elizabeth, thank you very much. That's Elizabeth Braw there of the American Enterprise Institute. And of course, concern about the war, the impact that's having on energy prices, all of that fueling economic uncertainty and the urgency of what central banks are doing right now. Joining us to get into it is BlackRock Vice Chairman Philipp Hildebrand. Philipp, thanks so much for joining. Okay. So I think it was about 2 weeks ago you said that it's unlikely the Fed can engineer a soft landing. And it sounds like everyone was listening to you, because markets felt like they started to turn. Recession fears came in. Inflation expectations fell down. Has anything changed in your mind?
No, I think, in fact, it's gotten more pronounced that we live in a world of trade-offs. So central bankers face a very difficult set of choices. They can either bring inflation down, but at a very heavy cost to the real economy. They'd have to essentially crush demand, raise interest rates very much in order to get inflation anywhere near the 2%. Or they can, at some point, accept that that cost is too high and you tolerate for some time higher inflation. You know, the only good news is I do believe we have reached peak inflation. Inflation will start to come down as financial conditions tighten, as central banks normalize rates. but we're not going to get to 2% without significant damage to the real economy.
That reminds me of what Jim Reeds over at Deutsche Bank said recently, that central banks, they usually stop hiking and start the cutting project, not necessarily when inflation gets to 2%, but when the trend is lower. If we have reached the peak in inflation, does that mean a cutting cycle might be sooner in the cards than perhaps markets and many people are expecting?
Oh, I think we're a long way away from that. The question will be whether at some point they pivot to tolerating higher inflation for some time. You know, for many decades, we've lived in what Ben Bernanke has coined the great moderation, which was essentially if you brought inflation down, everything else would be fine as well. This is no longer the case. The cost of bringing inflation back to 2% is now very, very high. And I believe that's going to become more and more apparent, at which point we're going to start to see the central banks facing this very difficult choice.
Wait, so what is that cost? Is it 5% unemployment for 5 years, like Larry Summers says?
I think it'll be in that kind of, deep recession territory if you wanted to really get inflation back to the kind of price stability definition that we've seen in the last decades, around 2%. I think that the cost of that will prove to be extremely, extremely high. And that's the new kind of world we live in. This is a very new era where you can't just get everything right if you stabilize inflation. There was a term in economics called divine coincidence, that if you could stabilize inflation, everything else would work out just fine. I don't think we live in that world anymore. And the reason for it is that this inflation regime is driven largely by the supply side. This is driven by the production side of the economy, not by excessive demand.
You know, Philip, Matt Miller here in New York. I thought it was interesting when I first heard Cathie Wood talk about a buildup in inventories. Of course, we saw that from Walmart and Target. But yesterday, Michael Burry of the Big Short fame was tweeting about deflationary pulses as well from a supply glut at retail. Is that going to help to reduce inflation? Is that going to help central banks in their quest to fight it?
Lots of things are going to contribute to inflation coming down slowly. The economy is slowing. We have tighter financial conditions. We have spreads widening in Europe. We have the supply side, still not recovering. But inflation is going to stay very sticky. So even if central banks, let's say, pause around neutral, if the Fed continues at this rate, they'll get to, let's say, the neutral rate by year end, perhaps even earlier. And inflation will start to come down, but it'll remain much higher than anything we've seen in the last years. And that's going to be the pivotal moment when we get to that point around neutral rates, and the central bank then has to decide, do we really push on? Do we really go and inflict the damage on the real economy, bring the economy into a recession in order to get inflation back to 2%? Or do we conclude that cost is too high, we're going to have to somehow accommodate some years of higher inflation? The tricky thing will be, or the most difficult thing, of course, is they can only do that if long-term inflation expectations remain anchored. You've mentioned Larry Summers. That's been his key concern all along, that if you do this experiment of higher inflation for some time, you risk that long-term inflation expectations become unanchored. So this is a very difficult set of challenges for central banks.
Well, and we've seen the University of Michigan Consumer Confidence Index hit an all-time low. We had, obviously, the supply chain issues, and it's clear that a lot of inflation came from that and the chip shortage. But we also had, $5 trillion of fiscal handouts here in the U.S. and a balance sheet at the Fed, low rates, and a balance sheet that doubled within 2 years. What do you think the other causes of inflation were that politicians and central bankers can avoid next time around?
Yes, my boss, Larry Fink, has said recently, I think the last couple of days, inflation has many seeds, and that's certainly true. It's true that we saw very late into the restart, when in fact we started seeing the activity coming up, we still saw fiscal stimulus coming in hard in the U.S. We saw continued central bank purchases of assets, right? I mean, the European Central Bank still hasn't even begun the process of normalizing interest rates. So it's certainly true that well into this period of the restart dynamic, you still saw very expansionary monetary and fiscal policy, and that has undoubtedly contributed to the inflation dynamic. But I think the kind of principal cause of this inflation is the massive disruptions we've seen on the production side of the economy, first as a result of the restart after the shutdowns, and then, of course, layered on top of it, in a sense, through the war, a very traditional energy price shock that has layered a second kind of supply shock on top of it. So you're right, inflation has many seats here, but I'd say that what is really new and different about any time in the last decades, relative to any time in the last decades, is this supply side driven dynamic around inflation.
Well, talking about these different macroeconomic dynamics and how they translate into investing, it has been a very tough year for stocks. It has also been a tough year for bonds. A 60-40 portfolio is not doing well. So I'm wondering what you view as that means for exposure investors will want to real assets like real estate, and whether those can act as a proper inflation hedge in this kind of environment.
I think you're right. In this new era where dynamics are fundamentally different, where this at the end of the Great Moderation, the sort of simple 60-40 portfolio approach is flawed, right? We need to rethink what it means to have a sustainable portfolio, as it were, for the long term in this kind of environment where you simply have these choices that central banks face and you can't get to a perfect outcome. A soft landing here, let's be very frank, is very unlikely, extremely unlikely, I think, to get this to a soft landing. So that causes real problems for the traditional portfolio, which means you need to think about how you diversify. Cash is not really an option at 9, 8, 7, 6% inflation. And so, investors are looking for new ways to think about their portfolio. Private markets is one of them, certainly. Now, we've also seen significant corrections if you look at the stock prices of the listed companies in the private market space. And that's natural because, at the end of the day, they also reflect, these private market assets also reflect the real economy. Underneath it, it's the same economy. And often, indeed, as you know, when people want to get out of private markets, they tend to do it through public markets. So I think we also need to recognize that there's a limit to which you can have differentiated pricing between public markets and private markets. And that's some of the dynamics we're seeing at the moment.
And continuing the conversation on investing, what goes into our portfolio, obviously ESG investing is a big part of the business strategy at BlackRock. You're investing in the transition. I'm wondering how you think about that at a time where there is a lot of questions around ESG metrics, a lot of concern about greenwashing.
Well, the fundamental story is, of course, the journey, the transition, as you say, to a decarbonized economy, which will mean a profound change in the way our economy operates. It's going to be slow, it's going to be long, and it's going to be bumpy. And it's going to entail an enormous amount of change. So what we want to do is bring our clients different opportunities to be part of this journey, to recognize the risks, but also see the opportunities as capital begins to reallocate. Remember, what does it really mean to say we're transitioning to a decarbonized economy? It means trillions of dollars will have to be redeployed, reallocated, and invested in different ways in innovation, in new sources of energy, as we're seeing right now in Europe, in basically building a new structure of the global economy. For that to happen, we need metrics, we need clarity. So we advocate very strongly that it's right for governments, for regulators to be all over this and make sure that we have transparency, uniform standards as far as possible across the global economy, and have real clarity for our investors, for our clients, as to what they're investing in. I think this is a key point. If they don't have the confidence that what is on the can is actually what's in the can, as it were, then we're not going to see this needed allocation that we need of capital.
Yeah, really quick here, Philipp, because we're almost out of time. Of course, you announced today this transition investing advisory council you've launched for the others whose clients are facing these questions. Do you think there's going to be a reckoning in this space over greenwashing? Just about 30 seconds here.
No, I think what we're seeing is, I welcome this very much, what's happening from the regulators. I think clients are going to look for the labels that are clear, for the transparency that's clear, and then they're going to look for partners that do this with integrity. And we want to be that partner to our client to help them be on this journey towards a decarbonized economy.
Of course, at a time when energy security is just so crucial for Europe as well. Philipp, thank you so much for joining us. We really appreciate it. Philipp Hildebrand there on BlackRock, everything from macro, and of course, their new Transition Investing Advisory Council. Well, that's it for Early Edition. More surveillance up ahead. This is Bloomberg.